a company most people don't see. Behind things you use every day: fridges, ACs, elevators, factory robots, and building systems. That's Midea, headquartered in Foshan and listed in Hong Kong and Shenzhen. Here is the simple picture: a consumer side, an industrial core, building systems on top, and automation tying it together. The footprint is global: 33 R&D centers, 43 plants, over 190,000 people across more than 200 markets. Beyond the pitch, what the feeling says about products, moat, channels, and the soft spots, let's break it down. Midea's platform has 4 blocks that work together: smart home, household appliances and whole home setups, energy and industrial tech, compressors, motors, drives, controllers, some chips, building tech, HVAC, heating, ventilation, air conditioning, VRF, variable refrigerant flow, chillers, elevators, plus iBUILDING for smart control. And finally, robotics and automation, mainly via KUKA, industrial robots and automated logistics. On top, MIoT connects equipment factories over the lifecycle, and Ento handles logistics from warehouse to delivery. That stack components, systems, software, service also shapes how Midea goes to market. How it reaches customers mirrors that split. For consumers, Midea sells through brand stores, retailers, and e-commerce, both under its own brands and as an OEM/ODM supplier. Overseas, the focus is to grow the own brand mix. In 2023, OBM was over 40% of overseas smart home. Now stepping back to scale and geography, 2023 revenue was around 59% China and 41% overseas. With dozens of R&D hubs and more than 20 plants outside China, Midea can localize production and service when tariffs or logistics shift. With routes to market set, what drives the economics? Upstream, Midea is number 1 in residential AC compressors, approximately 45% global share, and number 2 in refrigerator compressors, approximately 16%, bringing volume, bargaining power, and recurring supply to other brands. Downstream, KUKA ties Midea to automation demand in autos, electronics, and logistics, so it's not just an appliance story. Scoreboard, revenue rose from 141.7 billion RMB in 2014 to 372 billion in 2023, approximately 11.3% CAGR. 2015 was the only dip, minus 2%. 2017 jumped plus 51% on KUKA Toshiba Lifestyle scope and a hot AC cycle. EV to revenue compressed into 2022-2023, bigger business, lower multiple. Now 2024 Pulse. H1 217.3 billion RMB, Q3 319 billion RMB, plus 9.6%. From late August 2024, China's trade-in program, 15% subsidy, 2,000 RMB cap, one item per category, provided a partial Q3 tailwind. Most of the lift landed in Q4. Net, broader mix, strong component scale, and project service attachment, ready for margins and capabilities. The business runs 3 layers: components, systems, solutions. Components, energy and industrial tech, feed smart home and building tech. On top, robotics and automation, KUKA, enables full factory solutions. 2 software layers close the loop: MIoT, production, monitoring, quality, and iBUILDING, control energy management service. That's software plus service on top of hardware. Scale is the lever. Global R&D, large manufacturing bases, integrated service, spreading fixed costs, shortening product cycles, and localizing when policy or logistics change. Evidence: upstream leadership in compressors, motors. Downstream: H1 2024 domestic shares of 36% in unitary AC and over 21% in VRF prove Midea competes at the systems level, not only in parts. Now, where margins come from? Margins stay steady in the low teens, around 11 to 13%, from 2014-2023. Growth without sacrificing profitability. Bridge with the levers clear, let's see the competitive field and where the growth can come from. Across segments, Midea faces Haier and Whirlpool in appliances, Daikin and Gree in HVAC, Otis and Kone in elevators, and ABB, Fanuc and Yaskawa in factory automation, where it competes through KUKA. On policy, US tariffs still bite. Section 301 puts plus 25% on many China-made HVAC units and plus 7.5% on several components. Since 2025, a reciprocal layer adds 10% baseline plus country rates. China's reciprocal rate is temporarily reduced, but offshoring to Thailand and Indonesia still pays the reciprocal rates. Duties follow country of origin. First chart, mix. H1 2024, HVAC 46.7%, consumer 34.6%, robotics and over manufactured 8.4%, over 10.3%. So the core is HVAC plus consumer around 80%, near-term progress equal mix shift, not a new model. Second chart, why it works. Upstream scale, 45% global room AC compressors, 16% fridge compressors, leadership in AC and laundry motors. That volume drives cost advantage and bargaining power and cushions cycles via OEM supply. Looking ahead to 2030, it's segment by segment. Appliances, smart home, slow pound around 1 to 2% value CAGR, growth via brand plus costs, hence the overseas on-brand push. HVAC building tech, structural demand, cooling adoption in emerging markets, Europe's heat pump gap versus 2030 targets implies a step up this decade, advantage to full systems with iBUILDING plus service. Energy and industrial tech, by 2030, global battery storage could reach around 1.2 TW, driving demand for inverters, drives, and thermal management. Heat pumps also need compressors. And finally, robotics and automation via KUKA. Most demand sits in Asia, The install base grows on itself, and it follows the auto's electronic cycle, another growth leg. That's the field, the mix, and the 2030 runway. Next, the financials, starting with EPS. EPS climbs from 1.66 yuan in 2014 to 4.93 yuan in 2023, 3x, 12.9% CAGR. Growth is mostly operational, more volume and a better mix lift gross profit. Input and freight cycles swing margins, S&D and R&D step up in push years, and share count is flat. 2024 Pulse H1 basic EPS is 3.02 yuan, plus 13.1% year-on-year. Q3 4.58, supported by steady HVAC consumer demand and the trade-in stimulus. PPE per share edges up over 2014-2023. Two small steps in 2017 and early 2020s. Latest 4.5 in 2023 versus 73.5 yuan share price. That's approximately 6% of market cap in hard assets. Now market cap to tangible equity, the 2016-2017 jump reflects KUKA TLSC goodwill, compressing tangible equity while the stock re-rated. By 2022-2023, it normalizes around 3x as tangible equity compounds and the multiple cools. Fair for a quality industrial. 2014 to 2023, cash and debt rise together. Net stays near zero. By 2023, Midea is roughly net cash, essentially unlevered. Translation: earnings are earned from leverage, liquidity covers capex plus dividends without strain. Now capex. Low single-digit percentage of revenue through 2014-2023. Two modest build phases, 2017 and early 2020s. Then back toward maintenance by 2023. Efficient scaling supporting cash conversion. Cost is one side, cash discipline is the other. Quick view on working capital. The cash cycle compressed sharply in 2020-2021 and then re-widened to 8 to 9 days by 2023. Still below the low teens of the mid-2010s, but no longer at the 2021 trough. Free cash flow per share lagged EPS in 2020-2022 because operating cash was kept, receivables built, and a higher share of not-based settlements finance harm effects. In 2023, free cash flow jumps mainly on a stronger CFO, a broad working capital inflow, higher operating payables, smaller receivables drag, and more non-cash settlements. Not because capex fell or because narrow working capital days collapsed, they actually ticked up. On that base, price to free cash flow is approximately 7.24x on financial year 2023. At today's price, 9.7x on 2023 cash. And demanding, pending 2024 free cash flow to confirm durability. Return on equity remains high, 30% to around 22% in 2023. The fade is denominator math, equity compounding, with margins in a tight low teens band and leverage near zero. No profitability collapse, just a larger base. Even at around 22%, that's an excellent return on equity for an industrial. Now the dividend. Dividend per share rose through 2014-2023 to 3 yuan in financial year 2023. For financial year 2024, the dividend was raised to 3.5 yuan, which at 73.5 yuan implies approximately 4.8% yield. Financial year 2023 payout ratio was around 61% of EPS, generous, yet still leaving room to reinvest given light capex and near zero net debt. On the chart, the red trend line puts fair value around 93.7 yuan. At 73.5 yuan today, the dot sits just under trend and still inside the -1 sigma band, so it screens modestly cheap, not distressed. On financial year 2023, the stock traded at about 14.9x earnings. If I refresh with H1 and Q3 2024, I get an EPS of approximately 5.45 yuan, which put the current P/E ratio near 13.5x at 73.5 yuan. 10 years ago, Midea was big in appliances. Today, it's a HVAC-first platform. It builds the core of AC, compressors, motors, sells full air conditioning systems, room AC, VRF, chillers, heat pump solutions, and runs them with software and service over time. KUKA brings factory automation on top. Net result: a larger, smarter, harder to copy business that earns beyond the initial unit. The edge starts with AC. Owning the compressor gives cost and bargaining power, and Midea also supplies peels, which cushions cycles. In building AC, it wins projects and then stays for maintenance and energy management with iBUILDING, so revenue doesn't end at installation. Robotics add another long cycle leg. Financially, it's steady. Low teens margins, net cash balance sheet, better cash conversion in 2023, and a rising dividend. A setup built to compound. But it's not all rosy. Classic home appliances are a slow pound. Building AC is cyclical and policy sensitive. China's late 2024 trade-in subsidies provided a policy tailwind as they ramped from September, helpful near term, not a structural driver. Robotics follow auto-electronics cycles. On the US side, China origin HVAC still faces Section 301 up to plus 25%, and since 2025, a reciprocal layer. Offshoring helps, but duties follow country of origin. And while cash flow bounced in 2023, it needs 2024 confirmation because settlement mix previously capped operating cash. At 73.5 yuan today, the stock screens near 13.5x PE on a refreshed 2024 run rate, H1 plus Q3, which reads slightly undervalued rather than cheap. If HVAC is your lane and this story fits your playbook, today's price is a reasonable place to start a position and let the secular trend do the work. For the next few years, frame growth at 6 to 10% per year, but underwrite approximately 6% to stay conservative. Then, let compounding do the rest. Thanks for watching this deep dive until the end. If you found this analysis useful, Feel free to like, subscribe and share this video. Do you like Midea's products? Let me know in the comments. And if you want another consumer story, check out my Natural Food International video, the Black Sesame brand building steady returns.